Imagine for a moment that you are a wealthy merchant living in London in the year 1690. The air is thick with the smell of coal smoke and the salty tang of the River Thames. You have spent your entire life strictly saving, trading, and accumulating gold, fine silks, and rare spices. You are successful, but you want more. You want a legacy. So you decide to make one final, massive trade to secure your family's fortune for the next 3 generations. You liquidate everything. You take every single coin you own, you sell your estate, you call in every favor and every line of credit. With this mountain of capital, you purchase the single finest cargo ship available in the British Empire. She is a beauty, massive oak hull, towering masts, the best captain money can buy. You load this ship with the most expensive goods imaginable, ivory, gold bullion, and fine textiles, and you send it across the treacherous Atlantic Ocean towards the New World. For months you walk the docks of London, staring at the horizon. You sleep soundly, dreaming of the exponential riches that will arrive when that ship returns. You are already mentally spending the money. But then a letter arrives. It's not the captain. It's a report from a survivor of a convoy. A hurricane struck off the coast of the Caribbean. The waves were 40 feet high. Your ship, your magnificent, unsinkable investment, is gone. It rests at the bottom of the ocean. And just like that, in a single heartbeat, the narrative of your life changes. You aren't just poor, you are ruined, destitute. You face debtor's prison. Your family's future evaporates because you bet everything on one vessel navigating a stormy sea. Now rewind that story. Let's play it differently. Imagine that instead of buying that one massive, beautiful ship, you took that same mountain of gold and you walked down to the harbor. You found 10 different captains. Some were sailing to India for spices. Others were sailing to the Americas for tobacco. Some were just doing short, safe runs to France for wine. You bought shares in 10 different smaller ships. You split your fortune across them. 6 months later, the news comes in. It's a mixed bag. 2 of your ships sank in that terrible hurricane. One was raided by pirates off the coast of Africa and lost its cargo, but 7 of them made it back to port. The profits from those 7 ships didn't just cover the losses of the 3 that failed. They provided a healthy, robust return. You didn't become the richest man in England overnight, but you survived. You slept well at night. And most importantly, you are still in the game to trade another day. Welcome to MonsterInvest. I'm your host, Daniel, and today we are going deep into the oldest, most critical rule of survival in the financial ocean, diversification. Or, as your grandmother probably told you, why you should never, ever put all your eggs in one basket. It sounds like a cliche, doesn't it? We hear it so often that it becomes white noise. We tune it out. We think, yeah, Daniel, I get it. I own 5 different tech stocks, so I'm diversified. But let me ask you, are you really? Or are you just that merchant in 1690 who bought 5 different cabins on the same sinking ship? To understand why this is so difficult for us to do psychologically, and to really grasp the pain of getting it wrong, I want to tell you a story about 2 friends, Ben and Sarah. Let's start with Ben. Ben is a smart guy. He works in it, he has a high IQ, he reads the news, and he understands where the future is going. In 2020, Ben became obsessed with the electric vehicle revolution. He did his research, crunching numbers late into the night, and he found one company, let's call it Future Motors, that looked like the absolute future of transportation. The CEO was charismatic, like a rock star. The car designs looked like spaceships. The stock price was climbing every single day, green candle after green candle. Ben had $50,000 saved up from years of hard work. He looked at the boring old S&P 500, which was growing at maybe 8 or 10% a year, and he scoffed. He thought, that's too slow. That's for old people. I know Future Motors is the winner. So he pressed the button. He put the entire $50,000 into that one stock. For the first 6 months, Ben felt like a god. The stock doubled. His 50 grand became 100 grand. He was walking around parties, checking his phone every 5 minutes, showing people his portfolio. He told his friend Sarah that she was wasting her time with her boring strategy. He was already browsing listings for a beach house. The dopamine hit was incredible. He felt like he had cracked the code. But then there's Sarah. Sarah isn't a market wizard. She's a dentist. She doesn't have time to read annual reports or watch charts. She took her $50,000 and split it. She put some in a total stock market index, some in international stocks, a little bit in real estate, and kept some in bonds. When Ben's stock doubled, Sarah's portfolio only went up by 6%. Ben laughed at her. Sarah, he said, at this rate, you'll retire when you're 90. But then reality hit. The storm came for Ben. It wasn't even a big disaster initially. It was just complications. Future Motors had a supply chain issue. They couldn't get microchips. Then a battery recall caught fire in the press. Then the CEO tweeted something controversial and got sued by regulators. The stock dropped 20%. Ben thought, no worries, I'll buy the dip, it's just a correction. But then the macro environment changed. Interest rates rose. Suddenly, investors stopped pouring free money into speculative tech companies. They wanted safety. Future Motors had no profits, only promises. The stock dropped another 40%. Within 18 months, Ben's portfolio went from that high of 100,000 back down to his original 50, and then eventually down to $12,000. The psychological toll was devastating. Ben didn't just lose money, he lost time, he lost sleep. He was snapping at his wife. He stopped checking his phone because it made him physically sick to look at the red numbers. And the worst part, while his stock was crashing, the energy sector was booming because of global shortages. Healthcare stocks were steady. Sarah's boring portfolio, it was actually up slightly. She wasn't rich, but she was calm. She was sleeping fine. Ben was drowning because he was on a single ship in a storm. Sarah survived because she owned the fleet. This is the trap of concentration. Concentration builds wealth incredibly fast when you are right, but it destroys it even faster when you are wrong, and the market loves to prove us wrong. So how do we actually fix this? How do we move from being Ben to being Sarah without settling for mediocre returns? How do we build a portfolio that is bulletproof? True diversification isn't just about buying many things. If you buy 10 different cryptocurrencies, you aren't diversified, you are just a crypto investor. If crypto crashes, you lose everything. True diversification is about buying things that don't move in the same direction at the same time. In finance, we call this correlation. You want assets that hate each other. When one is zigging, you want the other to be zagging. Think of your portfolio like a professional football team. If you go out and hire the 11 best goalkeepers in the world, you have a team of great individual players, right? But you're going to lose every single match. Why? Because you have no one to score goals. You'll defend well, but you'll never win. On the flip side, if you hire 11 strikers, 11 aggressive forwards, you might score a lot of goals, but the moment the other team gets the ball, you have no defense. They will crush you. A winning portfolio needs position players. 1. The strikers. These are your high-growth assets. Tech stocks, emerging markets, maybe a tiny bit of crypto. They are aggressive, they are flashy. They score the points that grow your wealth, but like strikers, they get injured easily. They are volatile. 2. The defenders. These are your blue-chip dividend stocks, your healthcare companies, your utilities. They are boring. They aren't going to double in a month. But when the market gets rough, when the recession hits, they hold the line. They keep paying you dividends while the strikers are injured. 3. The goalie. This is your cash, your government bonds, or maybe gold. They are there to save you when everything else fails. When the stock market crashes 30%, your bonds might actually go up in value, or at least stay flat, cushioning the blow. When the economy is booming, your strikers are the heroes. You feel like a genius. When the economy crashes and enters a recession, your strikers stop scoring, but your defenders and your goalie keep you in the game. They prevent you from panic selling at the bottom. Let's look at a proper diversification strategy. It usually happens across 3 distinct layers. Layer 1 is asset classes. This is the big picture mix: stocks, bonds, cash, real estate. History shows us that these often move out of sync. For example, in 2008, the stock market collapsed, but US Treasury bonds skyrocketed. If you only owned stocks, you were wiped out. If you owned both, you had money in bonds that you could sell to buy cheap stocks. That is the magic of rebalancing. Layer 2 is sectors. This is where Ben failed. If you own Apple, Microsoft, Google, and Nvidia, you aren't diversified. You are just long technology. If the tech sector takes a hit, you take a hit. You need to mix technology with healthcare, with consumer staples, the companies that sell toothpaste, toilet paper, and soap, and with energy and financials. People stop buying Teslas in a recession, but they don't stop brushing their teeth. Layer 3 is geography. This is the one most people forget, and it's called home bias. If you live in the US and only buy US stocks, you're betting that the US economy will always outperform the world. But look at history. From 2000 to 2010, the US stock market basically went nowhere. It was a lost decade. But emerging markets like China, India, and Brazil, they boomed. Having a slice of the global pie protects you if your home country has a bad decade. Now I can hear some of you saying, but Daniel, wait a minute. Warren Buffett says that diversification is protection against ignorance. He says if you know what you're doing, you should concentrate your bets. And you are right, Buffett did say that. It's a famous quote. But here is the hard, uncomfortable truth that nobody wants to admit. You are not Warren Buffett. I am not Warren Buffett. Warren Buffett reads annual reports for 8 hours a day. He has been doing it for 70 years. He buys entire companies. He can call the CEO and tell them to change their strategy. He has control. For the rest of us who have jobs, families, hobbies, and lives, we don't have that information advantage. Unless you have that level of influence and knowledge, concentration is just gambling disguised as conviction. It's arrogance. The goal of MonsterInvest isn't to make you a billionaire by next Tuesday. If that's your goal, go to a casino. Our goal is to make sure you are wealthy, free, and secure 10, 20, 30 years from now. We want you to stay in the game. The only free lunch in investing is diversification. It is the only mathematical way to lower your risk without significantly lowering your expected return over the long haul. So before we wrap up, let's bring this all together. If you were zoning out or if you were distracted, listen to this part. Here is the summary of what you need to take away from this episode. First, diversification is survival insurance. It ensures that no single event, a lawsuit, a bad CEO, a war, or a new regulation can wipe you out. One holding going to zero should hurt. It should be annoying, but it shouldn't kill your financial future. Second, understand correlation. Don't just collect stocks like baseball cards. Don't buy 10 different stocks in the same industry and call it safety. Buy assets that behave differently. That friction between them is what stabilizes your wealth. Third, embrace the boredom. The hardest part of being diversified is psychological. At any given moment, something in your portfolio will be losing money. That is actually a good sign. It means you are diversified. If everything is going up at the same time, everything can crash at the same time. You have to be okay with being the tortoise, not the hare. Sarah didn't get the adrenaline rush that Ben got, but she won the race. Don't be the merchant who puts everything on one ship and prays for good weather. Be the fleet commander who conquers the ocean, regardless of the storm, one safe voyage at a time. If you found value in this story today, or if it made you rethink your own portfolio, please do me a favor. Hit that like button, subscribe to the channel, and share this episode with a friend who might be putting all their eggs in one basket. It really helps us grow the MonsterInvest community. This has been Daniel with MonsterInvest. Check your baskets, count your eggs, and I'll speak to you in the next episode.